Hey folks, Dan Ferro here. I'm with my friend Dan, and we actually have another guy in the background named Dan. We're here today to talk about fix and flips, how you qualify to get into this program. I think you're going to learn something today because I sure did. Okay, so the main reason I had you here is I don't have a clue about fix and flips. I'm just being honest. And I'm on my channel. I just give everybody my transparency.
Sure.
So I've been having a lot of people calling lately to maybe purchase or buy a fix and flip. But what I've really been having people coming in lately is they come in and they're looking to get out of the fix and flip because the house is done.
Sure.
The rate was a high rate and so forth. So what I want to talk about today is, thanks for coming on.
Of course.
Is how do the fix and flips work? So I'm going to kind of drill you on a couple questions because we have a lot of investors that watch our channel.
Yep.
So the market right now, what are you seeing there? We'll get to that in a second.
Sure.
Where do you expect, the housing market, maybe interest rates in general, to go in the next, maybe 2023 into 2024? And I know none of us have, just give me what your thoughts are.
Sure.
We're not going to debate it.
Yeah, no, we don't,
I just
no
want
one
to,
has a crystal ball, but yeah.
Because my thought process is this. We're in that time right now where we see house prices basically at the highest levels we've ever seen in history. So, but a lot of people are expecting a correction. Some people even say a crash. I don't think we're going to be a crash, but who knows?
Sure.
Okay. So we have a crash, and let's say now unemployment starts to spike because the Fed's doing what they're doing. Their goal here is to crush housing and crush the employment market.
Sure.
So let's just assume that house values start to come back down. Okay, but the unemployment rate spikes. And you have people now out of work.
Yep.
So thus, they might be forced to sell their houses.
Sure.
So is that part of your strategies, I guess, for the fix and flip program?
Sure.
Or I think you made a comment on one other video that I watched is you're like, the investors can always find deals.
That's right.
So,
Sure.
what are you thinking of all that
I think
stuff?
all good places to start. And I think in general, it's a unique moment. Right now, and there are lots of opportunities out there for investors. There will be. In terms of the market itself, started to see some shift. You made a comment about, investors that have come to you and said, hey, I've got my property finished, I want to refinance out. I think we're going to continue to see that in a good way, in that, a lot of investors struggle. They can execute the rehab, but they're not quite sure how to get out of it into a long-term loan and hold that for cash flow. It's one of the things that we do well. And I can talk about that more in depth a little bit later. But in terms of where the market's going, I think we're going to continue to see investors looking for those pockets of opportunity. You're talking about maybe, the Fed is going to continue to raise rates here, at least for the near term, the near to medium term. Going to continue to put pressure on housing, but that creates opportunities for investors, right? There may be some forced sales. There may be some distressed sales, not quite to the level of your 2008, 2009 real estate crash, but the fact of the matter remains is, as unemployment goes up, as the economy starts to soften a little bit, there are opportunities for real estate investors to swoop in, buy a property at below market, fix it up, and then they have the option, particularly given the market, they're probably going to want to hold that asset, right?
Yeah.
It's going to be a little harder for them to sell.
Yeah.
So they're going to want to fix it up and, just like you said, get into a long-term loan. I'm seeing that more and more often, and we've tailored some products specifically for those people.
That's pretty cool.
Yeah.
So just start me from the beginning. So the investor goes out. So if you're out there and you're wanting to buy a property, let's say a foreclosed property, it needs some work, because I get these calls all the time.
Sure.
Is, what product is good for me? Should I do the FHA renovation loan or this and that and this and that? Where is the fix and flip? What's the differences between the normal loans that you have, like the 203K loans, FHA, versus a fix and flip? Because honestly, I've never even heard of this product other than maybe a year or two ago.
Sure. No, it's a great question. I mean, I think the main difference between, say, your 203K loan or your FHA loan and then going with a private lender like ClearEdge would be, ease of use, and then there is not nearly as much, I would say, red tape to get from the starting line to the finish line. We can lend on properties that are unlivable. So as an investor, you're looking at your short sale, you're looking at your foreclosure. If you take that property to, even for a 203K loan, they're going to have a laundry list of, say, 40, 50 different items that you need to check off before they'll even let you in the front door. with ClearEdge, if you're looking at a fix and flip property, we're engineered to be as borrower friendly as possible.
Okay.
You know, we do an upfront borrower underwrite. It takes 2 to 3 days from the time we get an application in to the time that you're approved. You know exactly what leverage point that you are approved up to, and then you can go ahead and bid on that property and take it down and close between 2 and 3 weeks.
So in this case, you would be looking to do possibly a pre-approval?
That's right. That's right.
Okay,
Yep.
got it.
And
so what's the qualifications for somebody to get a pre-approval?
That's
Credit
right.
score wise, how much skin in the game do they need?
Yeah, great questions. Yeah, so what differentiates us, ClearEdge, from say a 203K loan or maybe even going into a bank is, you know, we're not going to be looking at your personal income. We qualify you based on your experience as an investor.
Interesting.
So that being said, you know, we do work with first-time investors as well. So anywhere from someone that's never done a fix and flip or fix and hold project, all the way to, you know, when I was driving here, I was actually talking to someone that had done 72 doors this year, and they were looking to leverage that. And so, you know, we're engineered to work with everyone from someone that's never done it before all the way to someone that's done it a lot. But what we do is we look at your track record.
Okay.
The more projects that you've done in the last 3 years, the higher the leverage that we'll lend to you on. And so we figured out over the years that the most important thing to look at in terms of risk as a lender in the fix and flip space is experience. So that's why we're engineered that way. And, you know, the leverage that we offer is compelling, you know, compared to a 203K loan or going into a bank. If you're an experienced investor and you have a deal that you want to bring to ClearEdge, you know, if you've done more than, say, 3 projects in the last 3 years, which a lot of folks have, we're going to be lending in at least 90% loan to cost. Whereas if you go to a bank or a 203K loan, you're going to be putting between 20 to 25% down each time.
Yeah, right.
So, I mean, just do the math. You could do 2 projects with us for the same equity contribution that you'd bring to a bank.
Got it.
And we're not looking at income. So the amount of red tape between you and that closing table is just negligible.
So if you're not looking at income though, how are you qualifying? Is it, let's say, can somebody do this on, so it cannot be a primary residency?
That's right.
I'm assuming.
It's got to be, so all non-owner occupied 1 to 30 unit residential properties. So anything from a single family home all the way up to a 30 unit apartment building. And we're looking at the initial borrower underwrite that I mentioned. You have to have at least a 640 credit score.
Okay.
So check that box, and then you fill out your track record. And you know, we do all that work internally. You just kind of fill it out, send it in. We have, you know, internal ops team that handles all of it for you. So really, you're just getting updates along the way. Once we've validated your experience, we give you that borrower pre-approval.
Okay.
We call it our line of credit. It's similar. Think of it as like almost an exposure limit.
Sure.
And you know exactly how much money you're pre-approved for and what your terms are going in, so you can compete against cash. Because, you know, as we've heard, you know, the large asset managers out there, they're snapping up these opportunities.
Right.
And so what we're doing is we're leveling the playing field and allowing, you know, your mom and pop investors, your you know, people that are doing between 1 and 10 deals a year to compete against the large asset managers. Since they've got their pre-approval, they can compete against cash. They know exactly how much they're going to have to put down. They know exactly what it's going to cost. And that way they can make that offer with confidence. We close the deal for them. We finance 100% of the rehab every single time, and they know exactly what they're putting down. So it enables someone to scale a business in a meaningful way with a minimal amount of effort.
Okay, so let's say I want to buy a property. It's a foreclosure. We know Illinois is rampant with foreclosures, and it's running even hotter right now throughout the whole country. So I want to buy a property. My credit score is good. I don't need to show you my income, but it's a dilapidated home.
Sure.
Okay, so it needs. So how do you guys work with me to get? We want to buy the house, but I'm an experienced rehabber, kind of, sort of. But who takes the reins of getting the contracts, reviewing the contracts, making sure? We all know when a contractor comes in, you're going to get a low bid, a high bid. They're going to miss some stuff. You're going to have the uh-oh moments and all that stuff.
That's true.
How does that? Because with a 203K full loan with FHA, you need a HUD counselor. They're going to be your subcontract. All this other stuff. Who kind of helps or controls that part of the transaction?
Sure. So, you know, we try and make it, or I know we make it a little bit easier for the investor in that way. You know, we don't require an investor to use a licensed general contractor. So if they want to do some of the work themselves or sub out some of the work themselves, That's acceptable. Any budget over 50 grand, we'll be doing a budget study to make sure that it works well for everybody.
Okay.
Because I want to make sure that investor is set up for success.
Right.
But basically they give us the budget of which they think is going to fund the property. We take a look at it so long as we're on the same page. We're funding it dollar for dollar as a reimbursement. So they close the loan, they do the work. We call an inspector out. Inspector takes some photos, sends it back to us, and we wire you the money within 3 days.
Okay, so I'm going to throw a curveball at you because there's always a curveball. You have a person that wants to do their own stuff. Let's say one of two things. They either underestimate how much the materials and all that stuff's going to be, or to get more money, maybe they overestimate. They say, well, lumber's going to be this much, and so forth. So they want more money to do even more. How do you really control? How do you know that the bids are good? I'm sure you have a lot of experience that's tough.
That's a great question. And I think we tackle it a number of different ways. First, as I mentioned, any budget over 50 grand, we're going to be looking at a little bit more under a microscope. We've been doing this for a long time. We have people on staff that understand costing, whether that be in, let's be honest, the cost of lumber is not the same in Silicon Valley as it is here in Chicago, right?
And it's not even close to where it was in March.
That's right. So we keep tabs on that on a routine basis, as that's our business. We need to know costs. And then also, we walk a home inspector through any home that we're going to lend on. If the budget's more than 50 grand, that's familiar with the area. So it's not someone that's never, let's say we're lending in Naperville, for example, in Illinois. It's going to be a local inspector. They're going to have the budget. They're going to walk through and mark it up.
Okay.
Before we close the loan, we send you the budget and say, hey, you sent us a budget for 50 grand. Based on our walkthrough, we think it should be 55. Are you good with that? By the way, you only pay interest on the money that you use.
Okay.
So, if we put in a $55,000 budget, you only use 50, you're only paying interest when you draw on up to $50,000. So it's not like you're being penalized. We just want to make sure that everyone's on the same team and that, we're setting the investor up for success up front.
Got it. Yep. So an investor that wants to break their teeth on the market, where do they go? Can they go to you as well?
Yeah, absolutely. Yeah,
and just don't forget, to go to him, you got to go through me.
That's right.
Just let me know.
That's right. So we will lend to people that have never done a fix and flip or a bridge, kind of investment property before. We do have some safeguards in place. We're not going to be at 90% loan to cost. We'll probably be at 80% loan to cost. But I got to tell you, especially given the market, there aren't a lot of lenders that are going to look at a first-time investor. It's tough to get your foot in the door.
Right.
And the alternative many times is like a true hard money loan, which is going to be much more expensive and less flexible than working with us at ClearEdge.
And that's what I'm getting right now. I'm getting the calls of the people that were in the fix and flips for the past, let's say, year that now are getting out of it. And a lot of them are freaking out because it's like, okay, I thought my rate was high on my hard money loan, and now it seems like a cheap rate compared to where the market's at today.
I think it pays to have someone in your corner that is a market expert and even a local expert. And I think that we can offer that as well, and that we have staff all over the country. So if you're looking at an investment property in Chicago, I'm your guy. I've been in the market for 15 years. I know the market. But if you're out in California, we have staff there. If you're out in Florida, we have staff there. So you're really talking to a market expert. And I think that given you mentioned off the top that, where do you think the market is going? Yeah. And I think that in order to really succeed, it's not going to be the investor that, say lives in Chicago and has never done a rehab before and has decided that New Mexico is the place to invest.
Yeah.
It's know your market, know even block by block, do your research, walk through the home, be as sure as you possibly can on your comps so that when you pull the trigger, you're protecting yourself. And that's why having a lender like ClearEdge in your corner can really help you.
Okay. There's one other piece, and we talked briefly before we came on camera. You were saying about what happens with a lot of the loans is the people get the fix and flip.
Yep.
They do the whole process, then they're done. So normally, like if you're building your own house, you get a construction loan, and then you need what's called an end loan at the end of it. Right. So on the fix and flip, the duration of that loan concludes because you're done with the financing.
Right.
Now what?
Sure. Yeah. Great question. And we at ClearEdge, we're specifically engineered to solve that for investors in a really friendly way. So
Okay.
a lot of people are buying, fixing, and holding now, as opposed to looking for that exit. Because to your point, the market is not maybe where it was a year ago. So, what we've done is we've set up a system where if a borrower comes to us for that fixed portion of the fix and hold, and they want to refinance into a long-term loan, we have no seasoning requirement to lend on the after repaired value. So I'll just give you a really simple example as to why that's important.
Yeah, sure.
So let's say that someone's trying to build a rental portfolio. They're doing the buy, rehab, refinance, repeat, the BRRRR method.
Yeah.
So they come to ClearEdge, they buy a property for $200,000, they put $50 into it, they get a tenant in there, it's worth $325. So most lenders, and I would say 98% of all other lenders out there, are going to make you wait at least 6 months, if not 12 months, with that tenant in the property before they're willing to consider lending on the after repaired value, that completed value.
Yep.
And as an investor, that doesn't work, right?
Right.
You're
stuck.
You're stuck. You want to get your money out of the
Right.
property into the next property. So with ClearEdge, if you do the initial fix part of the loan with us and you want to refinance into a long-term loan, we will lend on the after repaired value immediately once you get that tenant
So
in
as
there.
soon as you're done or close to,
As soon as you get a tenant in there.
saying,
Yeah,
okay. As
that's
soon as
right.
you have a tenant in there,
Yep.
they sign the lease and everything's good to go. You will then turn that fix and flip.
That's right.
Product
We will
into
we'll do a cash out long-term loan,
Okay.
up to 70% of the as completed value immediately. So the implication of that is, let's say you're all in for 300 as an investor, your property is now worth 425. We'll lend on 70% of that 425, let you pull all your money out and go purchase another property to fix and hold.
Got it.
And with a bank or with another private lender, hard money lender that doesn't have this capability, yeah, you can do it, but you're going to be at month 9.
Yeah,
Whereas in
it's gonna
ClearEdge,
take
you can
you a
do
while.
it
Yeah.
in month 4.
And a lot of times because of the increase in the value, then you start getting scrutinized how they go up in value
That's
so
right.
much and all
Yep.
this other stuff because you didn't buy it. You bought it for this, you held it,
Right.
and then they might have issues with that as
Right.
well. So
And
that's,
our attitude on that is, we trust the people that we work with. So, we've seen every dollar that's gone into that property. We know that the investor, we've vetted the investor's experience, as I said.
Sure.
We know they make their payments and we're really confident on that value. So why wouldn't we help them? Our mindset at ClearEdge is, let's go the extra mile for the borrower. We're always going to protect ourselves as a lender. We're not that extreme. We're not dumb, for lack of a better word. But we are specifically engineered to think, what would be best for the investor, as opposed to maybe what would be best for us as a lender. We think about the customer first, and that's how we design our programs.
See, the reason why I had you come in was, we've been talking with you guys for about a year, but I mean, we were on the brink. I don't do a lot of advertising for the fix and flip, so we don't get a lot of that. But I just thought the way the market was poised right now, there's a lot of, you have the institutional buyers stepping in, buying up everything.
That's right.
There's no, the only stuff left is scraps. I think I was wrong, because the way you guys talk, and like I said, it was just out of the blue yesterday because it's prominent in my head is because I knew I had this video going in today.
Yeah.
And yesterday, 2 calls.
Right. That's
Both
right.
people were
there.
basically at the end of the fix and flip, and they wanted refinancing.
That's
out.
right.
So what happened was yesterday I had 2 phone calls, and people called and said, I'm looking to refinance, and my question was, you realize where rates are, right? So why are you there was a why behind this thing. Why are you refinancing? Nobody's refinancing right now.
Sure.
And they said most of them had hard money. I mean, crazy high rates,
Right.
tons of fees.
That's
because
right.
they don't know about your product.
That's right. Yeah, I mean, I think you can kill 2 birds with 1 stone if you're an investor. So you work with ClearEdge on the fix and flip product. Our rates are better than hard money. Our service is certainly better. And then when you get to the end of the road, we already have a product for you to refinance into that long-term loan. So just forget the hassle of working with a hard money lender. Right. Skip it. Work with ClearEdge. You'll pay less. It'll be easier. And then you'll still have the ability to go into a long-term loan without having to sweat whether or not that bank that backed you up front is going to back you again. The other thing that I would say is from an investor's perspective, the market is. I guess you said you were surprised when you got the 2 phone calls about being refinancing from a hard money loan into a long-term loan. I think what a lot of people don't understand is the size of the market for fix and flip. It's last I saw, I was looking at a deck yesterday. It's estimated at like around $177 billion a year, of which 70% of that is bought all cash.
Wow.
So if you think about that as a market opportunity, you know, there's a huge amount of properties that are trading hands. You just don't hear about it as often because a lot of them are cash transactions, and it's very fragmented. So to your point about hard money lenders, it's not so much like, you know, people have a brand name that they know they can go to for fix and flip. Just like you said, hey, I'm not super familiar with these products. And I think that's where ClearEdge comes in, is that, you know, we are the institutionally backed brand name, for lack of a better word, for fix and flip, where you don't have to worry if your hard money lender who lends in one small town is going to be there, because you've got ClearEdge, and you know that we're going to be there through market cycles. You don't have to worry that, you know, 6 months from now, we're going to decide that we're not in the business. We're in the business for the long haul. And I continue to see, thinking about market trends, I see other lenders that are closing up shop that are saying, hey, you know what, this isn't for us. And I just view that as an opportunity. You know, it means that in tough times, you know, tough people come through those things.
Yeah, as long as you're prudent on your underwriting and all that. So like you made a comment at the beginning, and this is what I keep trying to preach to people, is this isn't 2008.
No.
You know, will we have well, I'll just ask you that question. I got in hot water on YouTube, and here's what I mean.
Okay.
I'm not the proponent of, you know, the world's crashing.
Sure.
You know, our house is overinflated. Yep. Are some markets way overinflated? Yeah.
Sure.
Are we going to see 2008? Well, worse than 2008? I don't know how, because that was a whole. You've been doing this for a long time. Just give me your thoughts on that. And there's no right or wrong answer. Just, you've been in the business long enough. I just want your opinion.
Yeah, I mean, I think there's a lot of differences if you look at 2008, 2009, and now. And a few of those key differences are the number of people that have fixed rate long-term mortgages at low rates on their house is vastly different, vastly higher now than it was in 2008 and 2009. Right. Also, the fundamental credit, like the fundamental underwriting of those loans, is significantly higher credit quality than it was in those adjustable rate mortgages in 2008, 2009. So we've got a huge cohort of people that have low fixed rate mortgages that are good credit quality, that as a result of the last few years, you kind of alluded to the appreciation that's happened, have a tremendous amount of equity in their homes. Right. So, you know, the credit quality is much, much larger. People have fixed rate loans that aren't changing. A lot of people have 2-3%.
I know, it's nuts. That's why that was referenced when the person called me and said they want to refinance. I haven't had anybody say that this year.
That's
you know
true.
What I mean? It's like, so, I want to refinance. Well, the rate's 7. Well, I don't want to refinance.
Yeah, so I think that, like, if you take a step back and you look at the bigger picture, you'll realize that those fundamental facets of the market that were weak in 2008 and 2009 are not weak now. That being said, there still are opportunities for investment in that, you know, I mean, let's just be honest, like there are markets out there that were overinflated over the last couple of years. And do I think that we'll see some correction there? Yes. I mean, the smartest people that I know are calling for an across the board reduction in national home prices by 5%. Over the next 24 to 48 months. So it's 12 to 24 months. And what that means is, in certain markets, like in the Midwest, and where things don't swing as much as they do, prices don't swing as much as they do, it's probably going to be flat. You know, maybe up slightly, maybe down just 1%, 0.5%. If you go to a market like Phoenix, you go to a market like San Francisco, and you bought at the height of the market, you know, there might be a chance that home value is going to go down by 10%, you know, year over year. But if you take a look back, take a step back, look at the bigger picture, and, you know, those prices, even if they come down 10%, there's still a tremendous amount of equity.
Huge.
And people aren't walking away from the homes. So, you know, I can understand why, you know, I can understand you could think it's a contrarian, you know, point of view to say that, whoa, the sky is not falling. And I think that, you know, if you say the sky is falling, you're going to get a lot of clicks, right?
Well, that was my whole point. I had friends of mine that would be sitting in that chair with you. They don't even text me back anymore because they're afraid, I guess, and I'm not trying to put them in jeopardy of anything. I just want to provide the truth. So that the reason why I asked you is I'm not trying to put you on the bubble. I just want opinions. Opinions of people in the business.
Yeah, I think that, you know, the more time you spend in the business, the more you realize, and this is true for both investors and lenders, that those that have an even-keeled point of view, a more objective point of view, you know, are making the better decisions, right? So, you know, if you're afraid the sky is falling, you're probably not making the best decisions that you could be. Whereas if you're take a more sober, even-keeled, you know, look at the market, you can take advantage of those opportunities. That's why the fix and flip product is there. The fix and hold product is there. Is that, you know, it's easy to make money when everyone else is making money, right. But people make fortunes when the economy is a little softer. And I think that is the opportunity. You know, no one ever made $1 billion when the market was when there wasn't an opportunity to swoop in and kind of take advantage of softening home prices. And I think that, like, you can look back at history, and, you know, there are people, actually I saw the other day, there's a large apartment aggregator that bought hundreds and hundreds and thousands of units in the Chicago area during 2008, 2009, 2010, when I was rehabbing homes. And I just saw they sold their portfolio for $600 million. And do you want to know why they sold their portfolio for $600 million? They do a nice job, and you know, they buy it for? They bought it for much less. Okay. Call it $120 million, something like that. So
they only made $500 million.
So they aggregated those properties during the downturn, right? Yeah. So they were not afraid. They took that sober approach, looking at the market, looking at the opportunity, and said, "Gosh, there's a lot of distressed properties out here. Everyone else is running the opposite direction. Why don't I stick to my guns, stick to what I know, and buy up those apartment buildings?" And sure enough, 10 years later, they sold it for, as you mentioned, $400 million more than they bought it for. It's a good example. Not a bad. I mean, and if they can do that, imagine what, you know, get your foot in the door, start with a single family home while the market is softening. What better time to build equity in your own business than, you know, when there's increased opportunity?
Got it. So what's my last curveball for you?
Sure.
Another one to get you in trouble on YouTube.
Uh-oh.
What do you think rates are going to go with the Fed? What they're doing, just your backdrop of the rates and that. There's no right answer because we don't know what the answer is going to be. But you're just educated ideas.
Yeah. I mean, I think. Listen, there's been a lot of headlines about what the Fed's done with interest rates and what that's done to housing in the last 6 months. And honestly, here's a contrarian opinion for you. I think that it was the healthiest thing they possibly could have done, and they did it quickly, and they did the right thing. In that, you know, if they had decided to make the rate hikes more gradual, sort of like what they did in the 80s, you know, we would have prolonged pain. And I almost think that, like, as an investor, as a lender, I want to know what's coming at me so I can plan for it. So that's what they did. And, you know, I think we're at the tail end of rate increases. I think we'll probably see, you know, maybe one or two other increases within the next 6 months, maybe 25 basis points instead of 75 basis points. And sorry, that's banker speak for, you know, a small
quarter percent.
Yeah.
I talk on my videos every day. Yeah. We talk about
I figured.
The basis points.
Basis
and all
points.
That stuff.
But you know, it's the rate hikes will slow, and then I can see probably towards the end of 2023, beginning of 2024, you know, some easing of those rates, and we'll start to see, you know, some of that price appreciation come back. Whereas, you know, we're going to see a little bit of a dip. It might be flat for a while, and then call it 12, 15 months from now, you'll start to see some recovery.
Got it. It's kind of like Illinois. We talk about the appreciation throughout the country,
right?
And you mentioned Illinois. I bought my house, and I don't live too far from here, 22 years ago.
Okay.
About $150,000 less than it's worth today. And
Okay.
it's not a cheap house.
Sure.
So we're not talking I bought it for $150 and it's worth $300. We're
Sure.
talking I bought it for a lot and it's only worth about $150 more than I bought
Sure.
22 years ago.
Yeah.
So we don't have, you know, when the people talk about the bubble,
Right.
we don't have a bubble.
That's right.
You know, there are pieces of the economy that, or the segment of the country that has that, but
Right.
you know, that's one of the things. So to conclude, what's the qualifications? Just if somebody's like, hey, I really like that.
Yep.
It sounds good. Let me see what I can come up with. What is a good scenario? This person is this is a qualified person we would love to work with.
Sure. Yeah. And I would say that I'll start by saying that, you know, as I mentioned, we work with people that have never done a rehab or never done a fix and flip loan, all the way up to people that are doing, you know, a dozen every month.
Credit score?
Credit score is 640.
Okay.
So check that box and then fill out a track record, fill out an application, and we do the upfront underwrite for free. So there's really no reason not to do it. There's no risk on the borrower's end. There's no risk on the investor's end.
How much skin in the game do they need?
So if you've never done
What I mean by skin in the game, how much money you have to come up with to close? Like, let's say, for example, there's 100,000. I want to buy 100,000 just to make it simple.
Yeah, sure.
$100,000 property.
Yep.
I need to put probably 100 grand in, and it's going to be worth 300 when we're done.
Sure.
So I buy it for 100. I need 100 more, and it's going to appreciate even 100 more than that.
Sure. Yep. So, if you've never done it before, we're going to be asking for 20% of that project cost down. So that would be $40,000.
Okay.
So, and then if you have done it before, we go up to 92.5% project cost financing. So meaning that like a little bit less than 10% down.
Okay.
And just to put that in context, banks are looking for, even no matter how experienced you are, you're putting down 25, 20%, 30%, somewhere in that range. So you fill out your application, we'll pull your credit. We give you your pre-approval. This is how much you're approved for fix and flip loans. We give you that leverage point. We give you your pricing, and just go shopping. Go look for deals.
So in conclusion, it's basically a DSCR with a FHA 203K full kind of loan product, kind of, sort of, if you get what I'm saying there.
Sure. Yeah.
So that's pretty awesome.
Yeah, no, I mean, I think it's a great opportunity, and it's even, just to draw a little bit of a difference, it's way easier than a 203K loan or FHA.
So let me get, if you want to buy an investment property and put money into it to fix it, you're going to have to go get a normal loan. Okay, it could be a FHA 203K loan or some kind of renovation loan with a conventional loan program. It's just a normal mortgage that you would think about. You're going to need at least 20 to 25% down. Plus, we're going to need all your income, your tax returns, your leases, your everything. This program is basically, it's serviced by the property. So you buy an investment property, as long as the rents basically cover the mortgage payment.
That's for our long-term loan, yeah, for our DSCR loan. That's right.
Then it should work. So there is tons less paperwork, qualifications, less red tape, and less money down. Why wouldn't you look at doing it if you're looking out there to do a fix and flip to buy a property, or if you're thinking of basically buying a property or sitting on the sidelines right now waiting for a market correction in some of these areas so you can jump in and do this? Like we were just saying, if there's no cost to get this done, there's no cost to get pre-approved, why wouldn't you do it? And the best way to get to Clear Edge is to go through us. All my information is down below. My name is Dan Free. I do these videos every day. So if you're interested in this and you find value in this video as well as others, please, all I ask you to do is give us a thumbs up, subscribe down below, hit the bell every time I post a video, you get an alert. I can't thank you enough for joining us here, because I learned a lot. I hated, when I started the video, I thought I threw you a curveball, like, dude, I've never done one of these. That's why you're here.
That's what I'm here for.
We had conversations on the phone. You were impressive. There's a lot of people, I get calls every day from people in the guidelines and everything. There's not a lot of people that end up in that chair. I enjoyed talking with you on the phone because of your knowledge. And I don't want anybody in the chair that really is vague. I want professionals there, because I don't want people to go to my channel and watch videos just to get the hype. I want them to really learn something. So I appreciate you coming in today.
I'm grateful for the opportunity, and I appreciate it, and I think that you've got quite a platform here, and from my perspective, there's no better place to talk to another market expert and to get the word out.
Sweet. Awesome. Well, thanks again. Thanks for coming in. Hope they have you back next time. Maybe we'll do this video in a couple more months. We'll let you guys know how things are coming along, if we've got any of these loans, how they're proceeding, and we'll give you some updates on that. So stay tuned for those, but thank you so much for watching. God bless. I'll see you next time. Bye-bye.